Hi everyone, and welcome to the Financial Horse Podcast. Today, we have with us Mr. Kelvin Lee. He's the co-founder and CEO of Fundnel. A former investment banker turned entrepreneur, Kelvin was previously in JP Morgan, covering clients in North and Southeast Asia. Since inception in 2015, Fundnel has raised over 1.8 billion USD, over 34 transactions completed to date.
So having done my time in traditional finance, having seen some of the deals that came and went in Singapore, I also realized that without having the experience that I did in JP Morgan, I wouldn't have started Fundnel. People don't get a choice to choose where they start their career in. But what we must remember is that things happen for a reason, and there's always learning opportunity for anyone that's young. And you don't really get to say whether or not you will learn something until you fully set your mind into absorbing every piece of information that you come across in whatever career that you're in right now, right? So yes, the dots did connect for me during my 25-year-old self. Even though I did tough times, I did long hours in traditional banking, but without that experience, it would have been tough for me to be where I am now. And I think with Fundnel, it's really about making a difference to the capital markets in our region. It's really about rebuilding that capital markets for the next generation of entrepreneurs that will stay private, that will choose to stay private longer, if not forever. And therefore, by being private, these companies, which are everyday companies around us, playing an important role in our community, they're not investable to the traditional investor. So how do I get these companies access to growth capital beyond just usual typical lending and borrowing? And how do I get the next generation of millennial investors a chance to invest our money into such companies around us, right? So being that platform, being the ecosystem that will make a difference to the companies around us is really what we started Fundnel for.
So what advice do you have for a young finance graduate today who is thinking of leaving their finance job to launch their own startup?
Shoehorning yourself into a career that used to be good is an entirely different matter. So what I mean by that is that I mentioned that I was in the right place at the right time, having done the right deals that shaped my thinking. But if I were to be given a choice to start it again now, and given the state of the equity capital markets in the region, I really don't think that I would have shoehorned myself into starting a career in traditional banking. I think it was announced yesterday late night that Deutsche Bank is restructuring its entire investment banking business. If you were a young finance graduate and you are still pursuing traditional banking, trying to get into the same industries that used to give you the best learning and best exit opportunities, I think we might need to reevaluate your longer term horizons, longer term objectives, and really think about what you want to do with your life before deciding to pursue a traditional career. And you're only young once, and you only have an unencumbered lifestyle without family, without kids, I guess once, hopefully. And therefore use that time not to maximize your monthly income. I think that monthly income, $1,000 more, $2,000 more a month, is really not as important and not as valuable as really learning the right skill sets and life lessons and making the right connections that will really further your self-development and broaden your thinking, right? So I think use that time when you're young to really learn, as opposed to be hung up on which job pays me $1,000 more a month. Because if that job is a dead-end job and will be replaced by the future machine, then maybe you're not learning the right skill set that will future-proof you for the next 20 years, right? And I think the saddest thing is when you see professionals in their 40s and 50s with a high monthly income, but not being able to retool themselves for the new economy, and therefore making them quite unemployable. Because to the new employers, I could get someone that is maybe 1/3 the price. Why do I need to buy or pay for someone that is so experienced, but in an industry that's not exactly relevant these days? One thing I know, I guess, from having invested in, I think, 9 Singapore-listed companies over the past close to 20 years that I've been investing, the 7 of the 9 companies on the SGX that I've invested in have been taken private. As a young investor, I would really only pursue growth companies. I wouldn't care about dividend-paying companies. As a young person, the only thing I have on my side is time, and therefore I really should be chasing the deals that give me not just 5%, 6% returns, but really about, can I make my money double? Can I make investments in companies like Impossible Foods, SpaceX that would really make a difference to my portfolio, right? There was an article published recently about an investor who invested $100,000 in Uber. When it went IPO, I think the guy is worth like over 30 mil. For instance, such companies would really make a difference.
So if I'm hearing you right, you're saying that for a young investor who's about 25 to 30 years old today, he shouldn't be focusing on yield stocks, but the emphasis should be on growth stocks.
Yes, I think emphasis on growth stocks. If not now, then when? You're not going to take a risk when you're 60 years old and you need your retirement funds. I think that's really not the time to play with growth and risk. I think for most people, we can always earn the 100,000 back again over time, as long as you're frugal and you don't go live beyond your means. The only young ones, I think that's the most important point. Yeah.
So for a young 25-year-old investor in Singapore, what's the easiest way to get access to these growth stocks?
Like I mentioned, if I had $100,000, I wouldn't put the full $100,000 into a single company, a single growth risk company. I would rather diversify the $100,000 into a portfolio that is managed professionally, into a basket of private equity type opportunities that previously was not accessible to the average investor based on the risk, based on the cost it took for traditional fund managers to onboard US and LP. And I think that's how stock picking, or really not about alpha creation but beta allocation for most guys into private equity really works, right? So I think there was a report about that came out earlier this month about Vanguard pursuing a private equity allocation to their funds, so much so that it reduces the cost of access to private equity. And I think with many research reports recently published, I think by the Wall Street Journal, that if you think about back then in 1995, if a regular investor wanted to make 7.5% return on the overall portfolio, they would have to allocate just 100% into corporate bonds, right? And they would make 7.5%. That was back in 1995. But in 2005, if the average investor did not have slightly more risky exposure into, the emerging economies, BRICs, Brazil, Russia, India, China at the time, one would struggle to make 7.5%. But in 2015, that same report suggests that if you don't have a 12% allocation into private equity, which most of us didn't, then we would struggle to actually make that same 7.5% return, really, because public market returns are shrinking. There is really about it's a race to the bottom about who can get me the same basket of public listed stocks at the lowest cost, right? So it really isn't about expanding your portfolio now. It's really about allocation. Yeah.
So you mentioned earlier that you have 2 kids. How do you plan to set your children up for investing success? What advice would you give to them?
When they were born, set aside the money into the child development account, so whereby the government actually matches money that you put in, and therefore gives you a pretty decent interest rate, if I'm not wrong, 2% or something, that can be used to settle your basic necessities and needs for your child. And similar to the way you think about investing in or leaving your money in, unfortunately, it's a touchy subject like CPF. People often do forget that some accounts within the CPF do give you a 4% return. That's honestly higher than what a lot of people can make by themselves on a sustainable, on a year-by-year basis, right? So I guess as Einstein most famously said, compounding is the most powerful force in the universe. Just by not touching the money and just by starting to invest for your children the day they are born, will give them more than sufficient income to survive, when they come of age, right? So just simple things like that. But then to really bring that portfolio further, I would do what I preach, which is to invest for them in growth companies and not really yield-bearing instruments, which will not really make or break the bank account. Yeah.
So as the founder of Fundnel, you probably see a huge number of companies coming to you guys for fundraising. So what's the one common factor that you see for all successful companies on your platform?
We're called Funnel because we see 50 to 60 deals per week, but the system actually weeds out 80% of these companies based on a quantitative screening criteria that gives us a score and tells us whether this company is ranked above or below its peer set in the same industry or the same geography, thereby allowing our investment team to prioritize our time to spend on the remaining 20%. And of the remaining 20%, roughly about 5% is launched to the network of investors, and only about 1% is invested eventually. And I think that's where the commonality for all these deals is that firstly, they didn't start out trying to say that they're going to be the next unicorn, but they really are trying to make a difference to the real economy that we live in. They're not all trying to do moonshots. They're really solving problems that you and I face as a regular person, right? So this is something that I would advise any companies that are trying to raise from investors in this part of the world. What I can say, investors on our platform are slightly more cautious and therefore looking out for companies with good execution and not just a okay idea. I mean, most ideas are honestly just okay. It's really about the execution, right? That will make a difference.